Welcome to ForexTV.com. Today's Wednesday, July 22nd. I'm Tim Kelly with the New York Forex Market Buzz. The dollar traded near 7-week low versus the euro as stocks paired losses, reducing demand for relative safety of the world's main reserve currency. The yen and dollar fell against higher yielding currencies as a gain in earnings at Apple offset an increase in bad loans at Wells Fargo and Company. The pound dropped versus the greenback after a research group said the UK housing price slump will persist until 2012. U.S. equities are between gains and losses, while crude is down slightly after the release of the weekly EIA data. Crude oil inventories fell again in the recent week, according to data released by the Energy Information Administration this morning. Gasoline stockpiles were higher. Both reports were on target with analyst projections. Gold futures are trading higher, and the yield on the U.S. government 10-year note is up 6 basis points to 3.53%. Today we're joined by John Person, President of National Futures. John, welcome to the program.
Thanks for having me, Tim.
Hey, John, these are always times where I look for your wisdom. Right now we've got Bernanke saying that, or implying, not his words, my words, but implying that the worst is in fact behind us. They don't see any foreseeable major events that would affect the economy. This seems like a day-to-day roller coaster, John. And the average trader who actually listens to government officials or follows government press releases on fundamental data can get a little confused. I'd like to know what you think about the shape of the economy and why.
Well, first off, I think it's important to listen to what comes out of, unfortunately, Washington, and listening to the semi-annual testimonies, which, obviously before Ben Bernanke was Alan Greenspan's tenure. These biannual events give us a kind of the opinion of what's going on, and it's also a further ear lashing as if times are difficult, as they are. People want answers. Congressional leaders have constituents that want answers. It's also what helps shape and dictates policy. And I was always taught, Tim, that if you want to know what's going to happen next in big market movements, follow the policies and fiscal and monetary changes. And so since Congress has the ability to change laws, you want to listen and pay attention to administration's ways and where they're going and moving with regulation changes. And that's one of the things that we understand right now, that we are going to go through a lot of regulatory changes, and I think that those changes are going to put a muted growth effect on the U.S. economy, but it's going to also at the same time instill confidence, and I think that's one of the things that we're going to probably see stability in the U.S. economy, stability in the banking system, and that may give us longer-term support in the U.S. dollar, because as we come with stability, we're going to come with, I think, a lot sooner than what's being talked about right now is a hike in U.S. interest rates sometime within 12 months. I would anticipate to see talk within 6 months. If we are on the same continued growth path right as we are now, Tim, I expect to hear a lot sooner that the Fed may be raising rates before they lower rates again, or at least keep rates this low.
Well, that's the first time I've heard that in a while, John. Hey, John, let me go back to something you mentioned about regulation. We're talking about regulation of the financial markets and not really regulation of the U.S. economy. Is that a fair statement?
Not only is that a fair statement, I'll go a step further and define that. It's also more tighter restrictions and regulations on what we do as consumers and borrowing practices as well. So I think that's one of the things that people, for mortgage lending and for bank lending policies.
Okay, that clarifies it enough, John. So in terms of expansion, you think that we're about 12 months away, and then the Fed will as we expand, have to tighten the credit markets and the money supply?
I think we're going to see a tightening in the credit, so we want to watch the LIBOR and we want to watch the spread on the yields between the 10 and the 30, the short end and the long end of the yield curve to give us some direction.
Hey, John, we've seen a lot of volatility in the short end of that curve, or as you describe it, the short end, the 10-year. In the past 2 weeks, we've probably seen a range of 30 basis points there. That is not common.
No, and Tim, let me go a step further. There's a lot of municipalities that issue debt. They're called municipal bonds. You have treasury bonds, municipal bonds, corporate bonds. There's a lot of supply in different varying forms that are being released. And this week we have 2, 5, and 7-year and a 20-year TIPS as a Treasury inflation protection issue that's going to be auctioned out. And I think, right now the risk, the appetite for risk suppression. In other words, people are more, they're not really as concerned about making money as they are to holding what they currently have. This whole thing about yield and interest rates, if there is no demand for these products, then guess what? Interest rates go up. And that's another factor that can cause prices to go down. And one of the things that's causing these yield spreads to get out of line. So keep that in mind. I think investors need to keep that in mind as we see instability in the real estate market. And it's not just homes and single-family home dwelling. It's also commercial real estate. There's a lot of defaults out there. People own these properties, these shopping malls that their main anchors have gone out. Think of all the people that have gone out of business. If you own a property, Tim, and your main anchor was Linens and Things, bankrupt. Sound Advice, bankrupt. Circuit City, bankrupt. These are empty shells, and guess what? You own that property. You've gone from a net inflow of capital to now you have a negative cash flow, and so that's going to affect the tax base of local municipalities. And so there's an issue at hand that I think is going to kind of keep a draw or at least a negative draw effect on the economy for the next 12 to 18 months.
Okay. Hey, John, let's shift gears now. You've kind of set the table here. Let's get into. I know you trade a narrow group of currencies. Let's start with euro and tell us what you think there. You would come out last time we spoke and we're looking for euro strength, pretty much contrary to most of the analysts I speak to, and had stuck with that regime, and to some extent you've been rewarded at this point. What are your thoughts at this point?
Well, I guess if you go with the masses, you end up being more wrong than right. So thank you very much for following up with that. From here, I think that we definitely want to look at the euro currency as maybe, and personally, I think from a seasonal perspective, we see weakness in the euro going into about the 3rd to 4th week of October. So I would say if the euro currency, and I'm talking spot, gets anywhere near this 143 up to 146 area, we have a potential double top forming right now from the June high of around that 143.38. If we take that out, my next upside target is 146, and I want to get heavily short going into the end of October. So I'll be watching this to see if that high of June is taken out sometime in the next 2 weeks. If not, we're going to form another summertime double top. Most people may remember we had one of those very similar patterns last year when we were near 160. And, we barely took out that high last year. We had a high at approximately 160.19, which formed in, I think it was April of '08. And then we took out that high by, 20 pips or so in July, middle of July, and then we crashed and burned. I'm looking for that same type of scenario. If we, so we're right up against 143. Maybe we take it out a little bit more this time around based on the interest rate differentials. But by gosh, Tim, I'm right now frothing at the mouth looking for selling opportunities.
So we're about 100 basis points off of that double top right now, but it's looking pretty strong there, John. So look, you're a cyclical.
Let me back up here. The high yesterday was 142.77, and in trading terms, that's, you're a half a point or so, or half a basis point away, 50 pips or so from that high. If we can challenge that high and fail, monthly, I don't know if a lot of your viewers look at longer-term pivot points. It's one of my specialties. The actual monthly predicted resistance for the euro currency spot is 143.30 area. So, up in here, I'm looking for sell signals if we can, but I definitely got to advise, if you're looking to chase this rally, you've come late to the party, hang out and wait for another week or two for some selling opportunities. That's my outlook, and I would say by mid-October, I wouldn't rule out the mid-130s, like 134 or so.
Okay, John, thanks. That's good specific trading. I'm looking at the charts now, and that double top is looking a bit ominous, so probably traders need to pay attention to that. Hey, John, let's shift gears over to sterling. I'm just looking at the charts right now. Still a little bit volatile, but not as much as it has been several weeks ago. Right now, 164.70 had been as high as 165, but couldn't hold the handle. What's your take there?
Well, we're actually starting a flattening top pattern, and notice that every time it gets up there, we seem to sell off not as much each time. The market's been respecting closer to this 165 area from closing bases. I mean, we had the first test of that level back in the beginning of June when we hit a high of around 166.60, and then we took that high out by a marginal amount to back at the end of June, around June 30th, around 167.40.
Right.
Sold back down. So what we had is a higher high marginally. Then that reactionary pullback was less pronounced than the June 5th sell-off. So we have higher high and a higher low, and now the market's trying to inch towards that 166 mark one more time. And perhaps if we do take that out, then I'm looking for 168, 170 zone. And, I'll be honest with you, as we enter August, we generally see sell-offs in the British pound lasting through about the 1st of November. So any further strength from here, another 200 to 500 pips in the pound. And most of you pound traders out there know that that's not something that's unusual. That can happen in a blink of an eye on any type of report, and you get it up in there. I would say if the market is heavily short, confirm this with some commitment of traders reports from the CFTC. Look to see if the small specs are net long. If it gets too far in advance of this rally stage, I'm looking to sell between that 168, 170 mark for the rest of the, or at least going into the first part of the fourth quarter.
Okay, good, John. That's interesting. But you mentioned that volatility that we've seen in prior weeks. About 3 weeks ago, we're seeing 300-400 basis points on a daily basis. So,
right.
Not surprising at all. Hey, John, we're running a little bit long. So
imagine that, Tim. I always hang out with the currencies in my limited experience. I mean, I don't trade all the currency pairs or the crosses, but I do tend to migrate towards the ones that are the most volatile. Right.
Well, that makes sense, and that's a dangerous game, but there are rewards to be reaped. Hey, John, in the time we have left, can you touch on dollar yen right now? I wish I could set you up here, but you're a smarter guy than I am when it comes to this because I can't seem to figure out what's going on here. But my guess is that based on what I've seen and heard that a lot of folks are looking for further dollar weakness against the yen.
Well, it's interesting. If you take the inverted price of the yen, spot yen, okay? If you take the inverted, so instead of going dollar yen, you go yen dollar, and you overlay the price of the 30-year Treasury bonds, you'll be amazed at how the Japanese yen actually trades in tandem to the prices. The inverted yen price trades in tandem with Treasury prices on the 30-year. So a lot of people are looking for maybe some dollar weakness. I believe that you're probably going to see the yen continue, and I would say the trend right now going from April when we were at that almost that 100, 101 level. Notice that we've seen consecutive series of lower highs and lower lows.
Right.
I would say that trend, in my opinion, is going to continue throughout October. That's a big shifting change in a fiscal end of fiscal year change. So I would say I would be looking for, and Tim, I hate to say this as a trader, but I'm due for a loser. But I think that the Japanese yen here has potential to possibly go back down and challenge the 89 handle in the
Interesting.
spot yen market.
Okay. Well, hey, John, we're going to leave it there. We are out of time for today. Always a pleasure, John. Hey, John, I got to tell you, I have mixed emotions when I get off the phone with you. I feel very dumb, but I feel a whole lot more enlightened after I get off the phone with you.
Well, Tim, I tell you what, I feel a whole lot more confirmed after having an interview with you, because that way, you get me to do my homework a little bit more succinctly, and thank you very much for having me on your show. Awesome company. You've got a great product, and hopefully your audience realizes that and keeps coming back for more.
Hey, John, thanks. We'll talk to you real soon.
Excellent, Tim. Have a great trading week for the rest of the week, and hope you conclude, everyone, a great trading month.
Thank you, John. This has been your New York Forex Market Buzz with John Person of National Futures. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.